everyone, this is Professor Kent. Today's recording is for chapter 4 and it is for income tax. And today we're going to be learning about taxable income, tax payable, and for individuals. So we're going to be talking about individuals. When we think of it for chapter 4, it is a big chapter. There's a lot of things in this chapter that we needed to learn. I will be spending 3 videos on learning the chapter, then 1 video on doing the examples at the back of the chapters. But the first part is going to be split in 2. Learning the chapter will be split in 2. So the first thing we have to work out is how do we transfer the net income to taxable income. The taxable income is that's where we pay our taxes. So what net income is made out of what? Employment income. If you're working for a company, you have an employment income. If you have a business or for property, that will be part of your net income. If you sold an asset, you will have a capital gain, and then that will be part of your net income. You could have other source of income. It could be interest income, could be any other source that is giving you some kind of income, that will be included part of your income. And what we are doing is we're allowed some deduction from this income, and we're going to be talking about those deductions, and then we'll be calculating a taxable income. And taxable income is used to pay the taxes to the CRA. Now this is where it is. Taxable income goes to my federal taxes. From there we minus the tax credits, and that's the money that it is owed to the CRA. When we think of deductions, these are some of the deductions. We have if you employee stock options, and that's in a deduction C. We're going to talk about deductions for payment that you already made. You could be making a lump sum payment to the CRA. You're allowed a capital gain deduction. If you live in the northern residence, you are allowed another deduction for that. And we also have losses that are deductible against the capital gains, and that you're going to learn in chapter 11. Now going further, when we think of deductions for payment, deductions is available. What does it do? It reduces my taxable income. If it reduces your taxable income, it reduces my tax payable. What are some of the deductions that are deductions for payment? They're saying it here is a exempt amount as a result of income tax treaty. Some of the amounts are exempt, means we don't pay taxes on it because we have a treaty with the Revenue Canada Canada has a treaty with the other countries. We could, if you workers' compensation, if somebody gets sick or get hurt on a job, they go on a workers' compensation, they receive payments from there. That is also part of the deductions. Income, sometimes some of the income is part of the deductions. Is the income from employment with prescribed international organizations. Some of the organizations that are international organizations, if you earn an income from them, you're allowed a deduction. The other one is social assistance payments made on the basis of the needs. So if I don't have enough income, they do Revenue Canada will do an income tax, will do an income test. When they do that, if I'm not making enough money, they will be providing me a social assistance payments. When we talk about gross income, we pay federal taxes. So these are the amount that we pay according to the income bracket we are, and these are called the brackets. So of course the lowest one is 15%. If you make from anywhere from 0 to 5587. That is my first tax bracket if I were to do it, and then I go to 20%, 20.5%. Anything I earn up to, let's if I don't earn anything, my first bracket is 15,000. So up to 55 864 is my first bracket. My second bracket is 55 to 87, 55 867. My federal tax will be 8,380. How is it going to be calculated? If I multiply by the 20.5%, I will get federal tax. So my marginal rate will be approximately that. But when we think of it, we calculated, how do we calculate it? We're going to go through the example to calculate your marginal tax rate, but these are the rates that we're working with. So if you're in 26% bracket, your federal tax payment will to the government will be that. If you're in 29% tax brackets, you will be paying government 35,860. If you are in a 33% tax bracket, you will be paying your federal tax payable will be 57,140. Now this is just the way it is. So when we think of it, the zero, when we think of it, and the taxable in excess of that money. So of course everybody makes money. So my first tax bracket is 15. My second tax bracket is 20.5. When we say this is my first, this is second, this is third, fourth, and the fifth tax bracket. So when we think of a marginal tax, if I think of it, up to this amount, anything I earn up to that amount, I pay 15% tax. So when I do that, 15,867 multiply by the 15, that's my tax payable to the government. My next bracket is up to this. So from this amount to this amount, I will be paying 20%, 20.5% tax. My first bracket was 83,880. My second bracket is difference between the two numbers, and I multiply by the 20.5%. Then my total tax payable to the government is my 19,803. So if I were to think about an average tax that I pay to the government, I pay in my first bracket, I pay in my second bracket. My average tax will be what the federal tax I owe to the government divided by my earnings, by my taxable income. That will give me an average tax. Then if you look in this case, this is a calculation, this is an example of how do I calculate my income tax payable. This is for an individual who earned 120,000. That's what his or her income tax, his taxable income is. Now we just calculated up for the tax on the first 111,733. What we did is we calculated that we pay a tax of 19,833, which made you in an average bracket of 17.73. But this individual earned 120,000. So what we're going to do is we're going to take the 120,000 minus what we already calculated, multiply by my third bracket, which is 26%. Altogether, this individual will pay 21,982. If I divided this by 120,000, that was their taxable income. They will be in an average rate of taxes will be 18.32%. Now that's a federal tax. We also pay something called provincial and a territorial income tax payable. So what happens is that whatever province we are, all provinces / territorial apply progressive rate to the taxable income. So we have something called minimum and we have something called maximum. These are the rates for 2024. These rates are for 2024. So when we think of it, they said the minimum the individual will pay 4% if you are in Nunavut, to this much 10.8% if you were in a Manitoba, you lived in Manitoba. Maximum will be 11.5% in Nunavut, and 21.8% in Newfoundland, so and Labrador. So Quebec is excluded from these ranges. So these are provincials and territorial progressive test. All individuals are subject to provincial and territorial tax. Business income do not pay any provincial or residential tax. When we think of we just calculated the federal tax payable, and then what we have is we have federal income tax credit that is available to us. There's two type: refundable or non-refundable. For many credits, a minimum of 15% is applied to these tax credits. So it is applied to 15% is applied. There's so many of the tax credits that are available, but it depends on an individual. So it doesn't, everybody doesn't get 15%. It depends on what your criteria is. You will get a 15% tax credit. So we're going to talk about a lot of the tax credits. These were, you don't have to memorize them, but at the beginning we memorize them, then we look at it, the individual, and then we see that what tax credit applies to that individual. When we think of the first one that we're going to be talking about is when we say BPA, we talk about basic personal amount. So that is available to Canadian individuals. If you're residents of Canada, that is available to you. How much is that basic amount? 15,705. This amount was in 2024. This amount increases every year. So it increases every year. So that's the, if your income is 173,205 or less, you will get 15,705 basic personal amount. And if your income is more than the 246,572, and you're allowed another basic personal amount that is available to you, which is 14,156. That's what it is. When we think of it, this basic personal amount, it is prorated according to your income. It is prorated according to your income. If we were to think about it, my first one was 15,705. That's my basic amount. And if I were to think about it, if I make more income, I will have another basic amount that is available to me. This is what it is, 246,751, and in this case it is more than the 246,751. If your income is between this and the 173,205 and 246,751, your basic personal amount is calculated as follows. So this is the formula that we follow. If I were to do that, of course you needed to, in this case, if you, as an example, is the net income is 200,000. So if individual's income is 200,000, on the first one, if I were to do that, my first bracket for the basic amount is 15,705. So that's your first one. And then if any income that is earned over that amount, we use this formula. When we think of it, you take your total income. This is my total income, net income minus what my first one was. My first base was 173,205. I Whatever the difference between the both, divided by the 73547. And how did we get the 7547? Then that is the number that we have to calculate. So that number is calculated difference between the both numbers. So if I take my first one, where my basic personal amount was that, my maximum was 246,751. If I take a difference between those two, it will be 73546, or we could just say 7 for this calculation. It is they're using 7, it should be 6, and I will get the 15,151, and that's what I will be using, and that is called a simplified formula to calculate the basic personal amount. If I have a spouse, or if I have a common law, what is a spouse and what is a common law? Spouse or a married persons are individuals who are legally married regardless of their gender or a gender identity of the individual. Common law is if you live with somebody, couple has cohabited for 12 months and do not have a child. Couple cohabited in conjugal relationship and are parent or a child, so they are common law. So in other words, if you live with somebody for 12 months, you are a common law relationship. That's what it means. So what happens is individual with spouse, so you will do a combined return. That's what it says. If you have a spouse, you will do a married return. If you live with a common law, you will tick a box in the income tax return that you live with a common law. So your deductions are dependent on according to your spousal, according to what you fall under when you are filing your tax return at the end of the year. So individual with spouses or common law, so what you get is you get 15%, individual 15% of your basic personal amount. Basic personal amount, we know that it is 15,705. If you have a spouse and your spouse is healthy and they have some income, or not too much income, they have some income, my basic amount is 15,705. Whatever net income your spouse made, you're allowed to take 15% of that. If your spouse is mentally or physically impaired, you're allowed you're allowed an extra credit. That means your basic amount, your 15,705, plus you're given 2616 for if your spouse is mentally or physically impaired, and then you would go to minus the net income that spouse earned, and you take 15% of that. Going further, if you get a credit if you have a individual sport, if you're sporting a dependent, for that, the condition to claim this tax credit, individual is either you're not married or living in a common law partnership, or separated and living apart from a spouse. So this, if you're sporting a dependent, then you can claim this credit, and you will be claiming as an eligible dependent, and they must live with the sporting individual in a self-contained domestic establishment. So what is this telling me? If I don't have a spouse but I have a child, or that is a called eligible dependent. I can claim 50% of the credit for this eligible dependent, and they will be uh, I'm allowed 15% eligible dependent credit, such as a basic personal amount for this child. The eligible dependent is has to be under the age of 18, or mentally or physically infirm, or individual's parent or a grandparent. They qualify under the eligible dependent. The eligible dependent does not include your aunt, uncle, nephew, nieces, cousins, and then living with the individual unless the child is away, related to you by blood. They're eligible dependent by marriage, common law partnership, or adoption, or a resident of Canada. Now, you cannot the eligible dependent credit cannot be claimed if you're claiming a spousal credit. If you have a spousal or a common law, if you have that, you cannot claim eligible dependent. If you don't have that, and you could claim a eligible dependent. Next one is caregiver amount for a child. You're allowed 15% credit of this amount, which is your credit becomes 392. So now it is applied to if you have a child and you providing that child a caregiver, and that child has a mental or physical infirmity. If that has if what does that mean? You have an infirm child lives with both parents or with a single person who claim or could have claimed eligible dependent credit. So that's what the caregiver amount is. So caregiver amount, we get a 15% of the 2,616. So my tax credits are 15%. I multiply by that in order to get a tax credit of 392. If a single person, for individual who do not have a spouse, or a common law partner, or a eligible dependent, a basic personal amount can be claimed. What is the basic amount? 15,705. I'm working with 2024. That's what we're working with. We're not working with 2025. Going with Canada Caregiver Tax Credit. It is available to individuals. Again, it's the same thing. It is available to individuals who support a mental or physically infirm individual who is either a spouse or a common law. Before was a dependent. Now it comes to if you either to a spouse or a common law. A dependent who is in the year is 18 year of age or older. Somebody who's 18 or over. It could be a grandchild, could be a child, could be a grandchild of an individual spouse, parent, grandparent, brother, sister, uncle, and nieces. They all qualify under this individual. So if you're taking care of somebody, that credit is available to you. And how much is that amount that is available? That amount is 8,375. That credit is reduced if that eligible dependent has a net income. If they have a net income, whatever their net income is, what we do is we minus 19,666. This is the threshold that is given to us by Revenue Canada, and we're allowed 15% of that. The maximum credit that is available for care tax credit is $1,256. Now we are given an income tax program. So when now at the beginning we needed to learn all these tax credits, and once we learn how to apply this tax credit, then your life becomes easier. How is it become easier? When you use a Cantex or profile software, you could just enter what is available to you, and then system automatically calculates all these credits for us. Now other tax credit that are available to individuals are, if you are 65 in the year, your tax credit base becomes 8,790, and then there's your reduction to tax credit base is 15% of individual's net income if it's more than 44,325. If you, in other words, we think of a 65, you retire, your income is going to get less, and then you're going to make less income, and your, of course, your tax credit base also changes. And any tax credit that you unused, you can transfer to your spouse could be your wife, husband, or a common law. It doesn't matter who they are, but it can be transferred to your common law or to a spouse. Next one is my pension. When does the pension comes? The pension comes is if when you retire, you are going to get a pension. It could be you getting pension from your company. Or when you get a pension from the companies, 15% of the first 2,000 eligible pension income, and you are allowed a credit of 300. So that's only on the first 2,000 of your eligible pension. When you retire, you also get some other pensions. So these pension credits is not allowed on for the amounts received from this. It is from eligible is from the companies. So when you work for a company, you get an eligible pension, and that it only applies to that. But if you get a pension from old age or Canada pension plan, it does not this credit does not apply to that. You have a salary deferral, you have a provincial pension plans, you have a retirement pension plan arrangements, you have a employee benefit plan, you have a death, you could get a death benefit plan. It does not apply to that. Next one is Canada Employment Tax Credit. What is that? We pay EI to if you are on a payroll, you work for a company and they put you on a payroll. When they put you on a payroll, if you are paying we call it EI. If you're paying an EI, what happens in that case? We are allowed a tax credit. The max they're saying is tax credit base is lesser of this number or whatever individual's employment income without considering any employment expenses. So the lesser of both, and we take the lesser amount, and what we do is we multiply by the 15%. That is my tax credit that is available to me for employment. If you are adopting a child, and if you're adopting a child, we get any adoption expense, we get a tax credit on that, but there's a limit for those credits. It is who is it available to? Available to individual who adopts eligible child. Eligible child is under the age of 18 years, so of the age at the time of adoption. So what we're doing is, when you think is when we are going to have expenses, if you're up to this amount is up to 19,066, we're allowed a tax credit of 15%. Our tax credit becomes 2,860. What the tax credit does is it reduces your liability, it reduces your tax payable to the government. Adoption expense claimed in the adoption is finalized, so you're going to keep receipts of it, how much you're paying, and then the when your adoption is finalized, that's when you're allowed that credit. So now what comes in your when we think of a adoption expense, what comes under that? You pay fees to the agency that you hire that is helping you with adoption, your court legal fees, you're traveling and living costs when you go visit the family or where you're adopting the child, any other reasonable adoption expense that is required by the agency, that is also part of that 19,066. Now, the next one is home accessibility tax credit that is available to seniors and people with disability. So that is available to and people with a disability. So what they do is, if you like for example, if you cannot climb the stairs and you needed to put a lift in, so that's what it is. So what happens is the tax credit is lesser of 20,000 and the amount of qualifying expenditures for the year. So we can lesser of 20,000, so we can spend up to 20,000, and 15% of that will be the 3,000 tax credit that is available to us in that case. Now, first, it is becoming hard to buy properties in Canada because the property value is so high. So if you are a first time home buyer, you are allowed a tax credit. It's available to only first time home buyers. That is what they can do is the credit base is first 10,000 of the cost of qualifying home, and what we're doing is you get $1,500 tax credit if you are buying a home. Of course, the prices of the houses are millions of dollars in Canada. My next one is, if we were to do it, next one is volunteer firefighter and volunteer search and rescue workers. They get a tax credit because you're volunteering. If you're volunteering, you're required to volunteer 200 hours of this volunteer service, either to a firefighter, to volunteer search and rescue, or combination of both. So what you are getting is 15% of 3,000, which is $450 tax credit that is available to you. I'm going to stop here, and there's 32 more slides that I have to do for the tax credits, and I'm going to record them, and then after I finish recording part B of chapter 4 or part 2 of chapter 4, then I'm going to record some questions at the back of the chapter so that you're able to we're able to put it into to theory into practice. Thank you so much for listening to me, and don't forget to subscribe to my channel. Take care and bye for now.